My wife always chastises me for being in blue shirts with respect to these videos. She tells me people are going to think it's the same video every week and not click into it. So to appease my wife, to honor St. Patrick's Day, but most importantly, to call your attention to the fact that this is a new and important message, please stick around. So what is this important message that's gotten me to give up my beloved blue shirts to put on this lovely forest green sweater for a day? It's this, that investors are likely unprepared for the markets to come and are expecting what has been to continue indefinitely, and that's probably not going to work out as many suspect. This last weekend marked the 10-year anniversary of the bottom of the bear market. In the 10 years since that, coming into this week, the average annual return for the S&P 500, the most widely followed and perhaps invested in market in the world, has been up 16.7% average a year. Goldman Sachs warning, we've issued similar warnings, other investment houses, but obviously they're one that many people understandably respect, is that that's unlikely to continue. The historic average for the US stock market is 10%. This is 16.7. What this doesn't mean is, and they're not saying that it's going to crash, but you could get a real moderating of returns. We certainly saw that last year. We're off to a good start this year, but largely have just made up fourth quarter losses from last year. And for investors after that run who are either chasing those types of returns with new dollars or for long invested dollars suddenly find themselves out of whack given the outperformance of the S&P 500, it might be a great time to reflect on a new approach. So what is the approach advocated for at least people's consideration by Goldman Sachs? It's one we've been telling you about for a little while here too, which is to find some higher income, lower beta, i.e. risk, investments to invest in and or help improve your diversification within your portfolio. Why is this a problem? We see this all the time, building out people's plans, evaluating portfolios that people have. Number one is people don't really know what they hold. They see a lot of different names on a statement. The industry, can't tell you why, tries to make it maybe more confusing than it needs to be. But they're not as diversified as they think they are. They're not as equipped for, again, volatility within their plan. They're banking on a continuation of these returns. And yes, if the market went up indefinitely 16.7% a year, most people would be fine. The likelihood of that happening is extremely low. So what's your plan when that doesn't work? If you Google sequence of returns risk, or reach out to us, we've shot plenty of videos and written plenty about this, you're gonna see what I'm talking about, which is if you retire or are about to retire or you have an event that you've been saving for and the market's timing doesn't match up with yours, which surprise, surprise, it probably won't, you could be in real danger of either A, not meeting your goal, or for the retiree, being able to have the longevity within your portfolio that you were counting on. Is there a way around that? Absolutely. And that's, again, focusing on trying to get a steady income stream off the portfolio. Before we get to a little bit about how to do that, some common misunderstandings that I want to clear up, hopefully once and for all. Number one, most importantly, just because you are focusing a little bit more than most on income generation doesn't mean your portfolio won't grow. Growth and income are not mutually exclusive things. In fact, if you look historically with respect to equities, dividend payers have been the best performing equities over long periods of time. Two, they experience a lot less volatility. Why is this important? Mitigates to a degree the sequence of returns risk if that income can match up with your plan. But two, it helps mitigate the emotional reactions that you have to the swings within the market. And finally, income investing isn't just about investing in the highest yielding products. This is another misconception we see, or we'll talk to people who've said, I'm already doing that, and you look at it and they own a ton of MLPs perhaps. Again, we're not against that. Or the highest yielding utility stocks or financial stocks. You don't want to get overweight, again, that's the point of being diversified, a certain sector, certain high yielding investments carry a lot of risk. That's not what income investing is about, is just chasing high-yielding stocks. It's about finding that right mix, finding an income stream that matches up, and hopefully, again, reduces volatility, doesn't accentuate it. Here's the opportunity, and again, to kind of come up with decoupling the last misconception, which is that income is somehow tied to total return, in the sense that if total return is down, your income is going to be down. That's another one. Well, if the market crashes, I'll lose my income. Dividends have proven to be very, very resilient. Pretty resilient in 2008 outside of TARP money. Flat, unlike a market that was down 50% in 2001. And if you even look at most recently last year, in a market in which 90% of global asset classes were negative, the average return for a diversified portfolio was down roughly 5%. The equity markets were down roughly 5%. Global dividends not only stayed steady, they actually grew by almost 10% last year. So for those income investors, not only did they have the income they might be counting on, but again, from an emotional perspective, they were able to see progress in a year in which it was hard to find from a total return perspective. So let's summarize it, bring it all together with this. Why do we care about this? I don't get paid differently to sell one investment versus another. I have no agenda in this other than helping get you to a good place and clearing up some common confusions, misconceptions, or maybe some implied beliefs about what might be in store. And again, we want to bring this to your attention. What could, again, to quote Goldman Sachs, higher income, lower beta, and better diversification mean to your portfolio at this point in the market cycle? It very well could mean relative outperformance. It'll help protect your retirement and the longevity of your portfolio because you can rely on that cash flow as opposed to a total return that might not be there. Even for the accumulators out there, you're accumulating ownership. That extra income generation that you can have can help you dollar cost average and accumulate more shares. And finally, it helps mitigate the emotions of being an investor. We can't say it enough. This is an emotional game. It's an emotional business, and it has to be factored in and mitigated so that you can stick with your plan and give it the time to see it be successful. With that, we wish you all a happy St. Patrick's Day. Thanks for joining us. We'll see you soon.